Well, for those who don't know, I'm Brenna Nath. I'm the director of HW Plus and events here at HW Media. And I'm the host. I have the pleasure of being the host of this great group of panelists for our Lunch and Learn today, which is focused on the battle against mortgage compression, which is a topic that we've been seeing in our newsroom and a lot of conversations I've been having in the industry, which we're excited to bring it to our attendees today. With the housing boom over the last few years, we all kind of went through it. Everyone hit market highs. And now that we're half a year into 2022, that narrative has drastically shifted, which is what we want to dive into today. Not only has this created some tough conversations between executives and team members, it's also really forcing people in companies to take a closer look at their processes, their workflows, their network. And so today in this Lunch and Learn, which is sponsored by True, we'll talk about what makes the cycle different, the resources that you need to be watching out to survive, and really some of the sentiment and the responses around margin compression and lower profits that's really kind of being talked about in this space. But let me go ahead and start off with a few housekeeping items, and then I'll jump into our expert group of panelists. But for those who haven't been with us before, or if this is your first time or you're a recurring guest at our Lunch and Learns, we do send a copy of this Lunch and Learn to you guys after the fact. So stay tuned to your email or go check out our Knowledge Center on HousingWire.com to get a full copy of this. We have a Q&A function. I think most everyone's familiar with Zoom by this point, so feel free to use that chat, that Q&A function at the beginning. Our panelists will be looking there for any questions that y'all may have, or save them to the end and we'll get to them at the end too. But I try to integrate those throughout this Lunch and Learn. We want it to be conversational and engaging, so feel free to ask away, especially with this great group. So let me go ahead and introduce our team today. First, we have Matt Conrad, who serves as the VP of Product Solutions at True. Welcome, Matt.
Hello, everybody.
We also have Marina Walsh, who serves as the Vice President of Industry Analysis over at the MBA. Super excited to have you here, Marina.
Thank you for having me.
And then coming in all the way from the Pacific Coast, we have Chuck Iverson, who serves as the President at Mason McDuffie Mortgage. Welcome, Chuck.
Thank you so much for having me.
And then rounding us out, we have Jody Hall, who serves as the President and COO at Nationwide Mortgage Bankers Americasa. So welcome, Jody, too.
Thank you so much. I'm glad to be here.
With this extra expert group, I'll go ahead and dive right into our first question, which really sets the scene for what we're hoping from this Lunch and Learn, which is for anyone who's been in the industry long enough. I think we all use the word market cycles. You know, we've gone through a few market cycles. I've been in the industry since 2013. I've witnessed my own few market cycles here and there. This one's a major one, drastically different. So we wanted to set the scene for everyone on this call. What makes this different? Where we are today that maybe wasn't forecasted at the beginning of the year? And what's different about this current market that differentiates itself from past cycles, especially in the context of what we're talking about here, which is margin compression, lower profitability, stuff like that. So trying to set the narrative about where we are today and what makes this market cycle unique. And maybe just kick us off, Matt, I'll start with you.
Sure. So some of the things that I've been in the business for about 30 years, and in the last 17 primarily on the analyst side as a service provider with a mortgage insurance company and now with True. What I have seen in this one is even the volume, app volume has compressed. Haven't seen that the other side of that, housing pricing compress. So there's still this really strong demand for purchases, but I think that a lot of there's low inventory and there's a lot of buyers that are getting priced out of the market. So this is just different. And I also think that high rents play into this. So high rents drive an investor demand to go and purchase these single family dwellings to put it back out there on the market. That increases the competition, especially among the first time home buyer population. I think it makes it very difficult. And that probably is also contributing to some of the lower application volume that we're seeing. I don't know if Chuck or Jody have seen the same thing in their origination spaces.
Yeah, well, I think, part of the question is, what's different this time than other slowdowns. And, even though the topic is margin compression, it's really driven by a lack of volume or a real decrease in volume. And, with the pace of inflation and the speed with which interest rates rose is what primarily makes us a differentiator. also first off, we're coming off one of the largest cycles ever. So everyone has done their best over the last 2 years to expand capacity, right? Which of course means more expenses, and you just have more people, and you may have invested in different technologies at that time, and they may or may not be coming to fruition in terms of the expense management side of it, because there's always this investment cycle in technology before you can actually yield the profits out of it. So we see that, and with the severity of the rate increases, I think we knew refinances would decrease, but if it's a little increase, you can still have cash out refinances, and you can have some volume in that. But it's been really to a point where refinances are very minimal. And then the purchase market itself just hasn't come to fruition as forecasted. And now we have affordability issues for the consumer themselves. I think there's concern because of this unprecedented run-up in housing prices as well, too. I'm hearing a lot of noise in the real estate community just about buyers' concerns. And I think we've seen some stats on cancellations of escrows and things like that indicate there's just a little nervousness out there on the buyer community. So I think to me, the really weirdest part of the market is this housing market, purchase market. And is it still going up in value? We have demand, there's no inventory, but there's still a lot of apprehension around it and a lack of affordability underlying it all. So it all leads to just lower volumes for us. And of course, we all race to the bottom on margins as soon as that happens.
Yeah.
For sure. The only thing I'll add to that is I really think what has changed largely, even since you think of 2018 and 2019, is the sharing of information. I feel like every conversation with an employee, every conversation with a client or referral partner, you're acting as a psychologist, because information is coming so quickly from all different angles that even talking about the increase in the short-term interest rates by the feds sends the shockwave. And I don't know if y'all remember in 2007, we used to sit and hit refresh on Google, or maybe, I don't even know if we used Google at that time, but we hit refresh on the mortgage grapevine, and we maybe would get an update every 24 hours as to what was going on with other lenders. Today, we're consuming thousands and thousands of pieces of information. And I think that there's largely a dramatic effect, emotional effect that we're experiencing that we haven't experienced in the past, because we didn't have access to that much information as quickly. So I think that there has to be a ton of communication for us as employers to our employees to be, to really be the calming effect for our employees for what's going on in the market. We have to be the calming effect for our clients. We have to be the calming effect for our referral partners, as our real estate agents are like, there's no inventory. I'm writing 50 offers on every house. So I think that is, if we had the same access to information in 2007 as we do today with social media and all media, would we think that it was different? I'm not sure that we would, other than there's a lot more regulation that has made people have a higher ability to repay. But I think, a lot of it is an emotional factor that is happening, and sometimes it's an overreaction. So what my hope is, we've had such a drastic reaction to one end, is that cycle comes down much faster, because we do have that access to information. So maybe we can emotionally push people into the cycle where it is all better and rates it better. But who knows? Maria definitely can tell us a lot more about that.
Yeah. That's a great point, Jody, because I think that just there's a shock factor, I know, on loan officers, just when they wake up one day and they're quoting a 6% rate instead of a 4% rate, and for consumers. And so whether, we get a pullback in rates or not, I think there is a settling in as the new norm takes place and the emotional factor comes down on it.
Yep, for sure.
Yep.
My next question is Maria.
I don't know.
Oh, I was going to say, do you want to chime in?
I was just going to ask because I think it's an interesting point about the velocity of information, does it seem like it can cause paralysis inside the organization just to make any kind of forward thinking change? And if you do think about making a change, do you find the organization may become resistant to it because there's just been so much shock introduced into the system?
I actually think it's the opposite, Matt. And
Okay.
the reason that I think that is because when things are going really well, so you think of a loan officer in 2020, 2021, they had as much business coming at them as they knew what to do with. And they almost
Right.
became, we were heavy purchase organization prior to, and then our, loan officers who concentrate on self-gen purchase business, all of a sudden they have people coming to them and saying, hey, I want to refi. I think that it put them in a different mindset. And when you go into, then all of a sudden you're like, oh no, like now what do? I have to go back to my roots, right? And I have to go back and I have to get in front of people and I have to work with my referral partners and I have to help, give them programs and platforms and, so that they can do more business. I think it's the perfect opportunity for change because no one wanted to change when their pipelines were full. They just wanted to be able to digest. Where now, as the market is a little more of a struggle, people all of a sudden like, wait, maybe I should listen. Like, maybe I should work on this product and selling this product and learn more about it. Or maybe I should like explore this platform that the company put out there for me a year ago to make me more efficient. So I think that people are more receptive to doing things differently when there is a struggle, where they might not be so much when there's not a struggle.
Right. That's interesting. Yeah.
So I have a few thoughts. Going back to Jody's comments on communications, I think that the Fed has done a pretty decent job of communicating what they're going to do with the Fed funds rate. And the good news about that is it became baked into the 30-year fixed rate mortgage. So it could be, this is as bad as it gets in terms of increases, because at an early point, we knew what was going to happen in terms of the rate increases. And so it could be baked in. So, how much higher are we going to go? Are we really going to go to 10% interest rate? I doubt it. And so that's a positive, that I think is a positive of communications. And in terms of the struggle and change for a lot of, mortgage companies that I talk to, it's just simply about survival. And I think staff understand that. We're in the survival mode. It's, we have to just get through some really, really difficult quarters as an industry. And so I think staff are more amenable to change when they know that this is a question of survival.
Okay.
Sure.
So Marina, one reason that super excited to have you on is you obviously are, you lead industry and analysis. You have so much data and research to show, constantly pumping them out. I know we have a couple of slides that we're going to share for you. Can you kind of set the scene, and then the rest of us, our panelists, I'll be here to ask questions. The rest of the panels will kind of give some color around this, but can you maybe set the scene for how you've seen the data shift when it comes to loan productivity? So that's a huge thing I think a lot of lenders and companies are looking at, along with the cost to originate. That really is that underlying metric that comes into margin compression, profitability.
Mm-hmm.
Does the cost to originate fall in that? So if you could give some data, and we'll be sharing the slides so you can dig into like what you've been seeing.
Sure. Well, productivity as well as cost to originate all start with volume. And so if you go to sort of our volume forecast, if you think about cost per loan, if you have that big denominator of loans and you have fixed costs, usually you see those costs dropping down. And then likewise for productivity, unless you're staffing up so quickly. But as an industry, we're always a little bit behind the times when it comes to being able to staff up and down given fluctuations in volume. But if you go to our volume forecast to start out with, because again, that shapes productivity. I'm seeing right now profit slide. But if you look at our overall volume, you know, we're coming off of the 2 best years in the history of mortgage at over, you know, 4 trillion in originations. The only other year that was close to that was back in 2003, when we were at, you know, just shy of 4 trillion. And so we're expecting a decline of 40% higher for refis dropping down by upwards of 70%. And then just this week, in our latest release of our weekly application survey, we reached a survey low. You know, that survey we've been conducting for decades, and we reached a survey, the lowest level in 22 years, since 2000. So I guess what I'm saying is we're in the worst of it right now. But going to your question, that sort of shapes where we are in terms of volume. So obviously, you know, Chuck referred to this, all of our other panelists also referred to it. We have a volume issue. But there are other things going on when you look at productivity and cost to originate. In terms of productivity, if you go back in time, here's a slide that looks at retail specific. So this doesn't include consumer direct or broker wholesale, but it looks at retail loans closed per loan officer, as well as for particular fulfillment positions, such as processors, underwriters, and closers. And so again, we're coming off these great years of 2020 and 2021, and we did see a bump up in 2020 in terms of productivity, but something else besides volume is going on when, you know, you go back to 2003. Again, if you think about relevant years, 2003 being similar volume to what we were experiencing in 2020 and 2021, we see a substantial dip in terms of productivity. And really, this is a function of a more complicated originations process driven by new regulations that are now in place at both the state level and the federal level. Underwriting a mortgage has become more difficult. Sometimes it's hard to get appraisals in certain areas. It's hard to find appraisers, particularly in markets like we had, in situations that we had over the past 2 years. So there's investor overlays now, which complicates productivity. So I guess what I'm saying is, yeah, we see a drop off in productivity, but it's a trend that we've seen going back since 2003. It's not simply because of a change in originations volume. And then likewise, going back to your question on cost to originate, if you look at the cost to originate and these rising loan balances and home price appreciation, you can forward along to the next slide to look at cost to originate. Next one. Here shows in basis points what's happening with both revenues and expenses. And so cost to originate now is upwards of $10,600 per loan. You have these rising home balances. Loan originator compensation rules certainly don't help because you're paying a certain basis points of fixed amount per loan originated. And so that's sort of leading in basis points to a rise in costs, in addition to a rise in costs in dollars per loan due to those higher loan balances. So we have the perfect storm of rising expenses, even at times in 2020 and 2021, where volume was actually increasing. We still saw those expenses go up. We made up for it in part through these very high revenues, but with margin compression, that's come back to earth. 350 is more of the average from, if you look at 2017 to the present, we fall somewhere around 350, 375 basis points in terms of total revenues. So it's something that, as an industry, we need to work on. And there's no easy solution because, especially on the sales side, those are the folks bringing in your product. But it is right now, as we see in the first quarter, and will probably continue into the second quarter, a perfect storm of that drop in revenue, as well as the rise in expenses due to volume and a number of other factors.
Love to hear color now from Matt, Jody, Chuck. How would you guys give color? Maybe Chuck, I'll start with you, to what Marina just showed.
Well, it's sobering, I would say,
Yeah.
and it's correct. I mean, the silver lining is that, truly if the industry was getting so much more efficient and you could click button, get loans, arguably there are much more efficient distribution systems out there like an Amazon or the banks or some of those folks. So in a strange way, the complexity is what keeps us in business. But we still have to grapple with it. And, I was in our pre-planning meeting for this, we were talking about this concept, about this complexity, because you could take a case study of I brought up this company Blend, and Blend which lots of smart people there, right, and have had a massive investment into analyzing the processes, and they've got some great tools, but I would argue that they haven't been able to disrupt or change our industry really in any way other than, helping the point of sale technology evolve and all those things. But that's an example where it's like, it's not like Uber where someone just can come in and like change it. Uber's one transaction. We have thousands of micro transactions in the process for a single mortgage. So it's a very, it is a very complex thing. I think this market is going to test everyone, and really there's not a singular focus you need to put into place. You have to really be a great operator right now, and you have to practice sales excellence. You have to take care of your sales team. You've got to have product expansion. You have to make sure your secondary marketing execution is the very best possible. You have to look at manufacturing and what you can do. And unfortunately, you have to manage your expenses as well, too, to a degree, which in some cases means, people. And you can see that across the industry. And it's in some ways, it's just math, and I guess the last thing, though, is that there's also opportunity as we see consolidation in the industry. And I'm getting ahead of myself because there's a question about loan officers. I think you have to persevere and understand that there's opportunity on the other side of this market, and these markets come and they go.
Mhm.
Yeah, to Chuck's point about, I see this as a huge opportunity, and being, well positioned and having been through the cycles over the years, being well positioned to gain market share. And whether that be programs and platforms and casting a wider net of clients and referral partners to bring in business, but also to acquire top talent. There's a ton of talent that is sitting there on the sidelines today because they are in the unfortunate position that their companies have shut down or have downsized. And we see that as a huge opportunity to continue to grow as a company. So although I think that Chuck and I are an advantage because our companies are primarily located on the coast. So we have our average loan sizes are large. So when you think about $10,000 cost to originate on a $500,000 loan versus a $200,000 average loan size, or even $300,000 loan size, we're an advantage because of that. So we've been a company that is primarily focused on purchase business. And I think that this is an opportunity to cleanse out, like anybody can do a refinance, right? Like, I feel like that we have a saying, we always say, if we're easy, everybody would do it. Well, refinances are easy, so everybody can do them. And you don't have to really spend a lot of time in training and developing your staff for refinance business. It's just transaction in, transaction out. You have to be much more skilled in the purchase environment. So we see it as an opportunity to kind of cleanse out those lenders that have, just were in it for the flash in the pan profit for the last 2 years. And our applications, just for some color, our applications are down as an organization, or our applications are down about 27% this year, but our credit pulls are up almost 1%. So what that tells me is, and we've also made the shift from 56% purchase last year to 73% year to date of being purchase applications. So what that tells me is as inventory starts to be available, we're going to go the applications will catch up with what the credit pulls are, and we're going to continue to recruit and attract top talent and look for unique ways, which I know we're going to talk about in a few minutes from a loan officer perspective. But I really see this as a huge opportunity for those who have positioned themselves well, who have always, tried to work with vendors that realize that they're going to help you in the bad times because you've kind of pushed them along in the good times, and having those contract conversations. And then from the technology perspective, we have to revolutionize the decades-long process. And I am confident that that we are going to do that. I think that we are definitely just like on the brink where we can Uberize, even though there are multiple things that complexities within the mortgage. I think that we can break that down into task-based workflow and really be able to push the industry forward. And if we can't, I'm going to die trying.
Yeah.
Oh, I'm with you on it. And it's just, it's just working on each piece to improve the whole.
Yep.
In an innovative way. And just, that's trying to eat the elephant one bite at a time.
Yeah, I would agree with that analogy. That I do think there's a big opportunity in the manufacturing process for automation, not in revolutionizing a whole process, but reducing the number of tasks, the repeatable, kind of the mindless tasks that must be done. It has to be done well. But if you can use automation to reduce the number of tasks, you get a lot of things. You get efficiency. That's great for the organization. You also increase your employee satisfaction, and you release those employees that you have that have those great talents. They understand the business to do the most meaningful thing, which is engage with your partners, your stakeholders, and help those borrowers through this journey. Because it's complex, and we're in the industry. It's all absolutely mind-blowing. You guys know this, to the borrower. They're like, why are we going through this? I bought a car in 10 minutes, and this is taking forever. But yeah, it's a very complex problem. And I really do focus in on the automation of the task level.
A few of y'all's answers, or really probably all of y'all's answers, really dove into the satisfaction and the experience of the LO. And something I think we discussed kind of heading into this call was, what is unique about the LO of today? I think Chuck, in one of his previous answers, really talked about how we still kind of we need the LO. I think that's something we're all thinking, the importance of the LO. So wanted to dive into that question a little bit more, knowing this market is different. How is this impacting the LO? What does the future of the LO look like? Especially knowing that oftentimes the ones that are still around are your top talent right now. When you're trying to hire them, sometimes, especially the ones who've been in the industry to the lot of market cycles that we're talking about, are the ones asking for really high comps. They're the ones who are saying, I want this giant sign-on bonus. So how is the narrative around the LO shifted going forward? And maybe Jody, starting with you, giving some color to your thoughts on what that looks like.
Yeah. I think that our top loan officers are successful and will continue to be successful, although they think if their production decreases 10%, that it's the apocalypse. But there's a reason that they're top producers, right? They want more and they're hungry. But the primary reason is they're relationship builders. And it's not transactional. And when we talk about technology allows us to have more purposeful interaction with our clients and our referral partners. So those loan officers that will adopt technology will allow to take that transactional feel out of the process. So they're not asking their client or their referral partner, hey, I need this. Like, what makes something feel more transactional than asking them for a piece of paper? So if we can take that part and we can solve that for our top producing loan officers, let them do what they're good at. And that's relationship building. That's calling and asking clients how they're feeling about the process. And hey, your loan's going to close. Is there any questions that I can answer leading up to close? And hey, do you have any friends and family that you can refer over to me? And the same thing with referral partners. They can, if we allow technology to do the marketing, we allow technology to collect the conditions, then the loan officers can focus with the referral partners on new programs and platforms that are available to help their referral partners grow their business, which will in turn grow our business. So we have to really focus on that and communicate that to our top producers. But at the same time, we have to look for a new type of loan officer. And what we have found in being able to do that is you have to commit to training, right? Because you can't just bring somebody from outside of the industry in and throw them out there and think that they're going to be able to sell a mortgage. You may be able to train them to get licensed, but it has to go further than that. You have to have a script diversity that tells them, hey, when a referral partner says this, you say that. And you really have to guide them on how to build that relationship, but also be able to get the products to them. So we thought that was because back in the day, it was like, hey, you had a drink and you really liked your bartender and you said, hey, come over and be a loan officer, and it worked out well. That's not working out well these days, but what we have seen work really well is take people who are already in the industry, realtors. There is one house for 50 realtors, it seems like. So they have to be looking for something to do. So we've seen some interest from realtors wanting to move over to loan officers, which gives us the ability to, if you have those training platforms in place, to train them to be able to sell mortgage loans. And they already have a huge network built of clients and referral partners in the industry. So I think that's extremely going to be extremely successful in a pivot. And then because they're not used to making, huge amount of commission, Dodd-Frank commission, they may not be looking to that extent and may be willing to cap earnings per loan or whatever it may be. But I think that, definitely that we are going to see a shift to those coming into the industry, and it's going to be those who will adopt technology will be more successful than others. And again, just like there's cleansing of mortgage lenders going on the process, there's a cleansing of loan officers, and loan officers who are afraid to get out from behind their computers. And you got to go back to what you used to do. It's boots on the street. You got to be willing to go into referral partners' offices and talk to them and communicate. And you can't do everything behind email and text messages because it is so much a relationship business that we exist in today.
That's the inconvenient truth of it, because I do see it's a convenience, but there's almost a guilt in the loan origination community. I need to have my social media up and running. I need to have this, I need to have that. And those are all important strategies and they're pillars of your strategy. But, the old saying is start with the tough task first. And that's getting out, creating, reinforcing, and strengthening your referral partners. And that's always been the core of the loan officer's job, and the top producers of today invested in those activities. They have to go back to those activities, and they have to be hungry enough to remember what it was like when they started out and they didn't have any other choice and do those things. So I think the question in some ways is what's the loan officer of the future look like? And really it's, at least from what I see in this next cycle, it's what the loan officer of yesterday looked like, in that it's a purchase referral generator who also now employs technology to analyze the customers they're after through MMI data and those types of things. It uses LinkedIn and Facebook to understand the prospects that are looking at for referral sources, but then goes out there and builds those relationships and can convert them. And at the heart of it all, we're in technical sales. when I came into the industry as a loan officer, I was in tech prior to that. And as soon as I got here, I'm like, oh my gosh, this is technical sales basically, right? So you have to have a mindset as an originator to study. We do have to train, but there has to be a real proactive mindset by the newer folks coming in to really adopt and embrace and understand the technology. And there's a finite amount of it. There's a lot of things to know, but it's definitely possible. I mean, I'm living proof of that. But at the end of the day, not only do they need to do that, but they have to have the courage to go out, courage and capacity to go out and create those relationships. We can then use, I think the last thing on that, because Jody did talk about this, is that we use technology, for our customer base. And we make sure that we're deploying that out there. So we're in touch with our past customers. I do think it's important that loan officers integrate a personal touch with that. A call structure, maybe Friday mornings is dedicated to calling certain past customers that are teed up for you. So you can use your technology that way. On our process and as a company, we use technology for predictability of experience. And that's what a loan officer is always represented to the marketplace. I'm going to, whatever I say, I'm going to analyze the situation. I'm going to tell you what you need. I'm going to tell you this can fund, and it's going to happen. And you can take that to the bank. We can deploy technology to make that easier, more predictable, or that they have to do less micromanagement so that they have, more space and confidence to go out and work on their referral source. And I think that's part of what Jody's talking about.
And I think that when a loan officer or an organization employs technology in that space, the technology's got to be flexible enough to allow the user of the technology to engage the stakeholder in the manner in which they want to be engaged in that moment. Because there can be a personal touch, there can be automation to it, but it has to be flexible because everybody's situation in the moment of that loan is going to be a little bit different. So and the ones that are going to be really successful with that is the ones that can do it in a flexible manner.
The only item I would add to this thread in terms of the future loan officer is to not forget about consumer direct. When you think about the different production channels, there's the traditional retail channel where the loan officer is going out there and everything that Chuck and Jody explained, going out there, relationship building. Then there's broker wholesale, correspondent just buying closed loans. And then there's this consumer direct piece. And we've been tracking the profitability of these different channels since 1999. And I'll say the most profitable channel is still consumer direct. If you look at the average over all these years, it's consumer direct. But here's the problem with consumer direct. Loan officer is different. Loan officer is largely outside of the required relationship building. There's a lot of reliance on either servicing portfolio retention, or there's reliance on business analytics, predictive analytics in that. And it's all refi. So what you see in consumer direct is these highs that are so high. I mean, we're talking over 200 basis points of net production income, but the lows are a lot lower than retail. Triple digit net production losses is what we were seeing in 2018. So, the holy grail that we've been talking about for a long time is how do you get purchase to consumer direct? That's an option. I don't know who's good out there doing that. Based on our survey of 110 lenders, there's very little purchase in consumer direct. It just hasn't been, but going back to technology, what can technology do to bring purchase to a consumer direct channel where it's a different profile for a loan officer?
Yeah, what we hear from our consumer direct group on purchases is it takes so many more touch points. You have to have 100 people interested in a purchase in consumer direct to get someone who qualifies. And so the qualifying factor is greater. So your typical consumer direct minded loan officer who is full credit, get DU findings, you're alone. In 15 days, you're done. It's really hard to get those same loan officers, and maybe that's where we focus as we continue to change the industry, as we focus on people from outside of the consumer direct model, either a loan officer who knows how to handle purchase business and knows that it's a longer loan cycle time, and that you're going to have to interact with a lot more potential clients to get a home run. Maybe it's focusing on an existing to consumer direct, or maybe it's as you bring new talent into the industry, that's where you start them, because you can, through social media advertising, you can get the leads to them. It's how quickly can you convert them, and what percentage can you convert?
I'm going to open this audience Q question that we kind of got in that I thought would be great to bring this group. It's from Ralph. And I know Marina and Matt, you kind of bring unique perspectives to this question. So maybe Marina, I'll start with you, because I know I think there's a different level, whether it's regulation or even some other direction you want to go with it. But he asks, we touched on how right now we have a lot of high producing loan officers that also want to get paid at the level that they are used, or not even used to, that they feel qualified for, right? So his question is, how can we pay experienced high producing loan officers at the levels that they see now and we see now, but still reduce the cost to originate? So how do we balance those two worlds? Are they mutually exclusive? What does that look like? And maybe Marina, you might have a unique angle. So
I would say it's tough to pay them, because sales of that $10,000, $300 or what have you, 10,000 plus at a lot of companies, the sales cost is upwards of 65% of the fully loaded costs. So something has to give. And unfortunately, unless we get, MBA is working on regulatory reform, but we don't have a very, an administration right now that necessarily will be amenable to any change in the loan originator compensation rules. But to have fixed compensation across all loans, including state bond loans, all loans across the board is really makes things difficult, I would say. So unfortunately, I don't have a good answer on that, because again, the loan officers, they're the ones that bring in the product. The only thing I can say is there has to be discipline in terms of, for instance, expense management branches, or whether you have corporate branches, making the hard decisions when you see that productivity dropping off, and when certain branches are going into the red, and being very disciplined about making those decisions.
I think too, some of it from a lender perspective is really looking at your, 2020, 2021, we went into contracts that were things that were nice to have. They weren't presenting any, return on investment, or at least not return on investment that you could quantify. So I had mentioned earlier, you have to look at all your contracts, and you have to make some tough decisions. It's like, would I rather keep, an underwriter and get rid of a PR firm that we have been using? So you have to look at all of your expenses across the organization and be very disciplined, even when we are in a boom, because what the cycles are, and really manage expenses. You also have to look at how many employees does it take to, and I think Marina, you had a slide on this about, how many FTE, non-sales FTEs are, how many closed loans per FTE. And I think through applying automation in the process, I really hope that we can get to a point where, a independent mortgage lender can double their volume with a 20% or less increase in those individuals that are outside of the sales teams. And I really do think that we can get there as an organization, as an industry. And I think that being able to do that, that's what's going to shape the cost and allow us still to pay those loan officers what they are used to earning and what they've earned to earn, because they're the face. That's who the client knows. That's who the referral partner knows. So I think that it really is that expense management and having really great relationships with your vendor partners So you can have those conversations like, listen, we were all fat and happy in 2020 and 2021, but now that we're not so fat and happy, you know, what can you do? Like, what gives? Like, let's see what rides the you know, when the next cycle comes. We still want to be partners. So help us through this tough time so that we can make a little bit of margin on the loans that we're closing.
Yeah, I think that reviewing the and vetting out the ROI on existing technology that you're employing, or even going into something new, it's really where the automation, I think, will come into play. Is that it's reducing that whole, the checkers who are checking the checkers. It's that redundant review process that goes on and on throughout the manufacturing cycle, all the way through to investor delivery. And I think that's where the biggest play is for, as far as on the operation side, for the cost. And you have to really do vet out the ROI on these things.
Yeah, I think, you know, so Matt, you know, the two big opportunities I see, one is, you know, with your firm and other firms that provide your services, just the aggregation of data necessary for completion of a mortgage. So, you know, through the document recognition technology, OCR technology, stripping that data, going for source data, and then keying that all up, or teeing it all up for a employee in a efficient UI workspace where they're just doing the calculations that are necessary for the true checking of the process. There's huge efficiencies that can be gained within that process. And, you know, we're engaged in that with one of your partners, Tavant. And I think that's really one of the ways that we can look at this efficiency. I think the other thing is with RPAs, because one of the other challenges that has really grown as an industry is you've got multiple systems, and you're taking a little bit of data from one system and you happen to take it and key it into another system. And so I think with the ability to automate the processes of moving data from one system to another, which is many times is repetitive. So you can use an RPA or other types of processes to create these what I call micro efficiencies. And you just keep looking for those opportunities over and over and over. That's really, you know, part of what we need to do as an industry.
Would you touched on it perfectly, Chuck. So I'm going to direct this to you to see if there's anything you'd like to add. Phil asked a question that really dives, I think, a little bit deeper into what you just said, if you wanted to expand on it. And he goes, if you were to automate a process, you know, in the mortgage process, where would you start to get the best pickup financially or efficiently in operation? So I think you touched on it some there, but to kind of dive into Phil's question a little bit more, is there anything you would add?
Well, there's a human element to this first as well too, and this would be directed to my loan origination staff, and they hear it from me, and all loan origination staff is whether you're using technology or technology plus your own actions to gather as much of the expected consumer data upfront as possible will always make a transaction better. I call it winning the first quarter. You got to win the first quarter, you know, and so that's a little bit of a human factor. We do see that anytime we use our point of sale technology. Surprise, the customers actually do a pretty good job of filling in the data, as well as, you know, I think there's a perception with loan officers that they don't want to give out their credentials still to this day for the automation, for the verification automations. And going to source data is like the holy grail. It's a better customer experience. The data is guaranteed, essentially, right? You don't have to validate it. In fact, it's actually signed off by the agencies, and there's no, you don't get, there's no recourse on. I mean, I shouldn't say that. There's no reps and I'm forgetting the word right now, but you're forgiven for any errors in that process. So that's really the holy grail, I think, to get all of that. You know, the second piece for me would be in this ADR, automated document recognition, and stripping of the data, and trying to get something into some sort of like an underwriter workbench. You know, there's a lot of inefficiencies in the setup process. There's a lot of inefficiencies in the document gathering process. and getting that data into your LOS system. And if you can figure out some ways to predictably do that, and of course you have to have exception handling, and that's usually where everything falls down is, because it's not 100%. So you need to either have, a company that's going to have an outsource process so that they can catch the errors for error handling, or you build those internal processes yourself. But I believe that's really where the biggest inefficiencies lie that should be tackled first.
Yeah, and my
I would. Oh, I'm sorry. Go ahead.
Oh,
I was going to agree. I'm sorry. I was just going to agree with Chuck real quick that I do believe that the vast majority of mortgages will always have some sort of documentation associated to it because it's just the level of validation services, the third party, the source, the truth of source, those kind of services that you can't catch everything. So a service that can go to the documentation, strip it out, do some sort of context recognition that this piece of data appears correct on multiple forms of this document, and then revealing the things to the person for the exception handling. Hey, this just doesn't appear right, or this doesn't match. I think that's a big opportunity in that space.
And what I would say, I have two answers for Phil. Start. Like, it doesn't matter where you start, just get off the bench and get in there, because I mean, if you do one thing, it'll start opening your mind to what can I do next. The other thing is start with what doesn't touch the client. We don't want to interrupt the client. What I mean by that, if you're going to introduce robotic process automation, then go for those things that are going to be least disruptive. Have a bot order your flood cert and pull the data off of the flood cert back into the LOS. Have the bot do your MERS transfers, because that's the most tedious, annoying thing that ever existed on the face of the earth, where someone has to plug into the loan operating system and click the button to transfer the MERS. So think of those like those redundant processes that have little impact on your loan officers and on your client. And then you'll just start thinking of more and more things. Oh, wait, if I did that, I can do this. And before you know it, you have a bunch of processes that are just automatically happening throughout your loan origination process that will help make you more efficient. But I think the biggest thing is, I mean, as an industry, we have talked about automation until it's like, it's disgusting. So just get off of the bench, get in it, do something, stop talking about it. And I think that that's the first place to start.
And another great place to start, MISMO, our Mortgage Industry Standards Maintenance Organization. We have working groups set up, meetings every quarter, in-person meetings, trying to develop standards for the industry. Please get involved with MISMO, www.mismo.org. It's partnering with MBA, but its own separate organization.
I would second that. I think it's absolutely vital. I've been involved with directly with MISMO since 2012, and I still to this day, I think it's a great place to get together as an industry and really solve these problems, because automation only works when you have standards underneath it. we have to speak the same language.
Well, as we reach the top of the hour one, I know we have even more questions in the queue, and I had questions. So you can tell this is a very important topic of discussion, because I think we could go for a lot longer than this when it comes to really this cycle and what we're seeing, what y'all are seeing. The question I think that would be good to end on and get everyone's thoughts on this panel is kind of combining two. So we spent most of this time talking about, this is what makes the sector unique. This is how we're dealing with top talent and their higher costs, the cost of mortgage that's changes, and even looking back to how revenue and the cost of originating has shifted. I think Chuck mentioned silver lining earlier, and I think this last question also gives that silver lining of looking forward. So what would you all say to, and you can kind of take this question whichever way you want to go, which is either, the advice that people need to hear in this market, or even like the biggest learning opportunity for lenders or companies as we head into the rest of 2022. We're, I was just on an interview earlier today with our lead analyst, Logan Motoshami, talking about the recession. And so there's a lot of factors going on right now. So what would you say, kind of ending on maybe a silver lining, or maybe it's kind of like a call to arms types of thing. Everyone needs to come together and do this, but whether it's advice, learning opportunity, how would you kind of cast or give notes to the future? And maybe Matt, I'll start with you.
Sure. So I would think that this really is the time to, like Jody had mentioned before, it is the time to embrace the change, and that, whether it's the change to go back to your roots where you started, or if you're doing in the industry, understand that first and foremost, this is a people business, and this is the most highly personal thing that you'll deal with that borrower with around their house. I think it's incredibly important. We're incredibly vital to the economy of this country, and I think that the employment of technology should be used to facilitate processes, make it more efficient, make it faster, but understand this is a people business. So that is truly, it's your stakeholders, it's your borrowers, it's that, focusing on that. That's where I would give the advice to.
Chuck, maybe if you want to go next, I'll help call out since
Yeah.
I'll call you guys out to help with talking.
That's helpful. Mine is more, I guess, from an attitude perspective. So for the fans of Good to Great out there, one of the principles that was brought forth in that book was the Stockdale paradox, which is, you have to confront the brutal facts, but always have an unwavering faith in your ability to persevere and to win on the other side of it. So I think that's the mindset that I have going into this right now. So you can't hide your head in the sand, but you also have to understand that you can make it through this. And so I look at it as a combination, first and foremost, of courage, the courage to really see things as they are. And from that courage, it gives you the willingness to take action, because we need to be a proactive industry. All of our employees, all my leadership team, they're on it right now. Our loan officers really need to, because they run their own businesses to a degree. They have to have that same mentality to have the courage and to take action. And then lastly, it's just persevere.
Jody, you can kind of give us your thoughts there, and we'll round out with Marina.
Yeah, I'm definitely all about, I think that passion and perseverance. First of all, why not be passionate, about what you do? It does make, it makes your existence a lot better. And then the perseverance will get us through. What I say to all of the mortgage leadership out there that is listening, if you don't feel right now like you're busier than you have ever been in your life, like even busier than 2020 and 2021, you are not setting yourself up. You're not setting your organization up. You're not setting up the future leaders of this industry, because you need to be working your butt off and looking for ways to stay optimistic and to prepare for the next wave of business or the next downturn in business. I have felt, even though production is down, I have felt overwhelmed, and that's largely due to pushing myself and pushing all of our leadership to gain education on different programs and platforms and different technology. You should be vetting as much technology as humanly possible right now. So if you're not tired right now and you don't feel busier than you've ever been, you're not trying hard enough to drive your organization forward and to drive the industry forward. And I think that you also have to relay that down to yourself. You have to be that psychologist, and you have to be that calming factor, that these are the things that we're going to do to help you get through this, whether it's the client, it's the referral partner, it's the loan officer, it's the processor whose pipeline is less full than they're used to it being. So you really have to be a counselor through the process, and you really have to work on your leadership abilities and abilities to push the industry forward.
Marina?
And I guess I'll focus on our MBA forecast that goes out 3 years, because today's purchase borrowers could very well be tomorrow's refi borrowers in 2024. We have our 30-year fixed rate mortgage going down to 4.3% by the end of 2024. So important to keep that in mind. Refis are going to pick up at some point in time. Purchases are going to pick up more than what they're picking up now. So that's a positive given the ebb and flow in the industry. And then last but not least, I'll just say mortgage financing is not going away. You look at other industries and their product just simply disappears.
Right.
I mean, home ownership is not going away. You're not going to have 100% cash buy, you're not going to have cash buyers taking over this industry. So there will always be a need. The 30-year fixed rate mortgage is here to stay. It's not going away.
Sure.
I love that silver lining. A lot of great
Great.
quotes here too. I write our HA Plus member newsletter every 3 times a week. So I have one per Sunday. And I'm going to take some of these great courage, perseverance, silver lining talks. I think is some, not just good news, but the silver lining I think is great, to your point, Marina, that we should focus on. The 30-year mortgage is here. People are still buying houses. I love my home type of thing. So as a reminder for everyone who wasn't here with us at the beginning, or just if you need the quick refresh, we are sending a copy of this webinar, of this Lunch and Learn, to everyone who attended. So you can either check your email for it or go to our Knowledge Center to get a copy again, take notes. This is a lot of great information, and really thank you everyone for your great questions to our attendees. Then of course, Jody, Marina, Chuck, Matt, thank you for really just sharing your insights and taking the time with us here at HW Media to share your guys' thoughts on the market.
Absolutely. Thank you
Thanks
for
so
having me.
much.
Thank
Yeah.
you.
Thanks, everyone.
Thanks for the opportunity.